Welcome to this video on interest rate risk, which is intended for those involved in the asset liability management function, including personnel and members of a bank's asset liability committee. In this video, we'll discuss the modeling process and the various types of systems or models that are commonly used to measure a bank's exposure to interest rate risk. We'll also briefly touch on model assumptions.
Let's start by talking about the modeling process. The modeling process follows several steps, which begin with gathering data. Gathering data can be a complicated process since there are often numerous sources and methods. It could include downloads from the internal loan and deposit systems, external feeds for the investment portfolio, and integrations with the general ledger. Data management involves developing a chart of accounts that maps the various sources of information into the models. Even a basic design flaw in the chart of accounts can flow through the entire modeling process and distort the end results. Another important component of data gathering is establishing the level of account aggregation. In general, the greater the aggregation, the less precise the model. For example, if the data feed is strictly based upon regulatory financial filings, the inputs may not be sufficiently granular to provide meaningful results.
Forecasting assumptions involves estimating how interest rate changes, prepayments, and deposits would potentially impact earnings and the balance sheet. Management teams focus a lot of attention on this step because critical model assumptions are determined based upon bank-specific experience, customer behavior, industry data, as well as other qualitative and quantitative factors. Gathering data and forecasting assumptions are the main drivers behind interest rate risk measurement systems. Finally, output is generated from the measurement systems. The models produce reports that allow management to perform level and trend analysis, evaluate key assumptions, and compare results to risk tolerances.
There are several commonly used measurement systems, which can be divided into two broad categories: short-term and long-term models. Short-term models look at earnings at risk and include gap analysis and income simulation models. Long-term models, on the other hand, measure capital at risk or extended earnings exposure. The primary example of a capital at risk measurement is an economic value of equity model, or EVE model. Extended income simulation models can assess the impact of certain products with embedded options extending beyond the 2-year time period used in standard income simulations.
Many banks employ a combination of both short-term and long-term models. When selecting an interest rate risk measurement system, some important factors to consider can include the overall cost, the data management requirements, and the level of in-house expertise. We'll touch on each type of measurement system, beginning with a brief discussion of gap analysis.
Gap analysis is the simplest measure of interest rate risk and is often considered the easiest measurement system to understand. Gap analysis identifies asset-liability repricing mismatches within a bank's balance sheet and can provide a rough estimate of the risk to earnings from adverse interest rate movements. Typically, the balance sheet is assumed to be static, so possible growth distortion is eliminated. One drawback of gap analysis is the inability to effectively model other types of risk besides repricing risk. Another is the use of simplistic data inputs and assumptions that do not fully capture a bank's asset and liability characteristics. Because of the limitations of gap analysis, advances in computer technology, and increases in affordability, even less complex banks have trended towards adopting more sophisticated models with income simulation capabilities.
The income simulation model is the most common measurement system used in community banks, given its versatility. Income simulations estimate cash flows from assets and liabilities over selected time periods and are commonly run over 2-year time periods. However, longer-term horizons can be modeled through extended income simulations to fully assess the impacts of certain products with embedded options that extend beyond the 2-year time horizon used in standard income simulations. Extended income simulations can be effective in identifying risk exposures that are embedded within the EVE models. Income simulations are used to project future earnings performance using scenarios where interest rate changes vary in severity and magnitude.
These simulations are also capable of both static and dynamic modeling. It's important that management performs static modeling, which is based on current exposures and assumes no future growth. This is because dynamic modeling may mask the level of interest rate risk that is embedded in the existing balance sheet. But dynamic income simulations can be useful for measuring interest rate risk from a business planning and budgeting perspective.
One of the primary advantages of this type of model is that it has robust features that can capture multiple types of interest rate risk, including repricing, option, yield curve, and basis risk. However, simulation models are highly dependent on assumptions and may require more data inputs, advanced information systems, and greater technical expertise than other interest rate risk measurement systems.
Simulation results are often displayed as a table. The base case projects net interest income assuming no changes in interest rates. Once a base case has been established, management can then measure what happens when interest rates change.
For example, assuming rates increase by 300 basis points, net interest income is forecasted to decline by 10%. The model also shows what happens when rates decline by 100 basis points. In this scenario, net interest income improves by 5%. In general, the most effective scenarios are severe yet plausible given the current level of interest rates and the interest rate cycle. When using income simulation models, it is useful to measure interest rate risk exposures over at least a 2-year time period to capture any risks that may surface beyond the initial time horizons.
In this example, by year 2, the exposure to rising interest rates has increased, and net interest income is forecasted to decline by 15%. In the scenario in which interest rates decline, the results still look favorable. To fully assess the various types of interest rate risk present within the balance sheet, an analysis over longer time horizons may be required. In this example, net interest income declines by 30% per year on average in years 3, 4, and 5, though results are favorable in the negative scenario. By only running the simulation over 2 years, this exposure would not have been identified. Measuring both short-term and long-term interest rate risk exposures can help banks assess the full impact on earnings and capital. A well-managed interest rate risk framework will consider both earnings and capital perspectives.
An EVE methodology is the most common long-term interest rate risk valuation model. EVE measures the degree to which the economic value of a bank's balance sheet changes under different interest rate scenarios. This approach provides a long-term view as it captures all future cash flows expected from existing assets, liabilities, and off-balance sheet items, and it can consider embedded options in the typical balance sheet.
EVE employs net present value techniques using a static balance sheet. Similar to income simulations, EVE models can capture multiple types of interest rate risk and are highly assumption dependent. Assumptions, such as discount rates and deposit lives, can be complex to derive, yet are important components of the modeling process.
The results of an EVE model are often presented as a table. In this example, the balance sheet is exposed to rising interest rates as the EVE declines by 25% from the base case in an immediate rate increase of 300 basis points. A decline of this magnitude may or may not be appropriate depending on the risk profile of the bank, but it is essential for management to be aware of what is causing the long-term exposure. EVE models employ complex assumptions and calculations, and they can be challenging to understand. Therefore, focus initially on EVE volatility, or the percentage change from base case, and then drill down to specific balance sheet categories, such as securities or deposits, to determine what is driving those changes.
Measurement systems are reliant on various assumptions, though some are considered more critical than others. Appropriate model assumptions and the ability to reasonably capture the volatility of income and cash flows can help ensure an effective measurement system. In addition, it's beneficial to ensure that key model assumptions are documented, understood, and reported to the Asset Liability Committee and the Board. Further, model assumptions are typically updated regularly, with updates reported to the Board or Asset Liability Committee. A common question raised by management teams is how often do assumptions need to be updated? Generally, banks typically revisit assumptions when material changes occur that may alter those assumptions. Aside from material changes, many banks find it helpful to revisit assumptions annually.
Typical assumptions include rate changes, deposits, asset prepayments, embedded options, account aggregation, driver rates, and balance sheet. Measurement systems are highly dependent upon assumptions, so when selecting a model for your bank, it can be helpful to consider both the balance sheet composition and what the model's capabilities are. The most effective models incorporate realistic assumptions so that proper results can be generated.
Some questions that can be considered when assessing your bank's measurement system include: what data sources does your model draw from, and are they reliable? What are the most critical assumptions used in your model? Has your bank's balance sheet and off-balance sheet activity increased in complexity over time? Is your interest rate risk measurement system still appropriate for your bank's current risk profile? Does your income simulation model account for any significant volumes of non-interest income? Remember, there are a variety of measurement systems available to assess a bank's interest rate risk profile, and each type of model has different capabilities. An effective interest rate risk measurement system captures all material on and off balance sheet positions and measures the bank's short and long-term exposure to earnings and capital. The model selection process considers each bank's complexity in conjunction with its risk profile.
The measurement systems generally incorporate product attributes, provide for appropriate aggregation, and capture the optionality embedded within the on and off balance sheet exposures. In addition, cost, data management requirements, and the level of in-house expertise necessary to ensure the successful implementation of the model is typically considered.
As we conclude, we'd like to remind you that the FDIC has additional videos and resources that can be found on the Banker Resource Center at www.fdic.gov. If you need additional information or have questions or comments, please contact your bank's case manager or email the FDIC at supervision@fdic.gov. Thank you for viewing this video. We hope you found it both useful and informative.